Hello all, welcome to today's session, taxation on capital gains. This is going to be a very interesting topic to have a discussion on because many people, uh, even though salaried, they some point of time have some income arising from capital gains. And many people who are just getting into the asset, they are trying to build their wealth, they are trying to accumulate some asset, and they don't know or rather very less idea on how the taxation on capital gains happens. So in today's session we are going to understand the taxability of asset. Firstly, we are going to understand what is an asset, what is going to be the holding period, what will be the tax rate, and how it should be reported in the income tax return. And hopefully at the end of the session people will be having much more clarity about the taxation part of capital asset. Now, my name is CA Shoykot Roy. I have been a part of ClearTax family for last 4 years, and today I would like to extend a warm welcome to everyone who have joined us with today's session on understanding the taxability of capital gains. Now, let's first understand what constitutes a capital asset. Now, capital asset is a quite broad term per se. It actually includes both movable asset and immovable asset. However, not all the assets fall within the ambit of capital gains taxation. So, for example, asset that is actually brought under the ambit of taxes. Now, if I want to summarize the capital asset in the eyes of income taxes, broadly, your land and building, shares, securities, gold, those items are the paintings, sculptures, works of art. Those items are usually covered under capital gains, capital assets. And whenever you are selling them, either you are accruing capital gains or capital losses. Now, here is a very interesting concept of acquiring capital asset. Now, we will at the time of our discussion, we'll consider the fact that capital asset, when what will be the holding period, right? Or from when the capital asset is acquired. From that point of time, do I consider it to be holding period? So to that, the day usually we are under the perception, if we are strictly talking about a immovable property, let's say a flat, we are under consideration. We also consider that the day I registered the property in my name, from that period our holding period starts. But there are a lot of judgments issued by the tribunals or high courts, wherein it has been mentioned that from the date you acquire a right in that particular asset, from that day your date of acquisition begins. So it's a very interesting proposition, and it actually goes against our belief that from the day the asset is registered in my name, from that very day that I will be considering that asset to be my own asset. But it's not the case. From the day I gain a right on that particular asset, from that very day, my right on that asset, my ownership on that asset begins. Now, why there is this need to determine from when I acquired that asset? Because from the day I start acquiring the asset till the point of time I'm selling the asset, it is called as holding period. Now, based on the holding period, whether this is a long-term asset or a short-term asset, that is determined. And the tax rate and taxability and the exemption that actually very much dependent on the holding period. If you look into the tax laws that is already there in India, for long-term asset, there is certain benefit that is given to you via the tax law. So therefore, it is very important to determine the from which date you have started to hold on to that asset. And for date of disposal, the date you are selling off that asset, that should be very easy to figure out. But date of acquisition is something very tricky. So for flats, the date in from which your right on that particular asset is generated is guaranteed. From that, the ownership of that asset starts in your hand. Moving on, a long-term asset and a short-term asset. In the Income Tax Act, it has been shown any asset which is not a short-term asset is called to be a long-term capital asset. So, long-term capital asset, the answer is pretty straightforward. Now, let's try to understand what constitutes a short-term capital asset. Now, for short-term capital asset, there are three dates mentioned or three. Sorry, we seem to have. So for short-term asset, for shares and securities, the short-term asset is a time period of 12 months. So if I'm holding on to an asset which is not more than 12 months, which is not more than 12 months, that asset becomes my short-term asset. So if I hold on to the asset for a period up to 12 months, that will be considered to be a short-term asset. If I hold the asset even one day more than 12 months, that will be considered to be a long-term capital asset. And this, I'm strictly talking about shares and securities that are listed in India. Now, coming to the other category of assets, the holding period is 24 months. Now, the holding period is 24 months for land and building, the immovable property, and unlisted shares. Now, for these two classes of asset, if you are holding them for a period up to 24 months, it will be considered to be a short-term asset. If you are holding them for a period exceeding 24 months, that means 24 months plus one day, it will be treated as long-term capital asset. And finally, for all the other asset, the holding period is 36 months. So if you are holding, let's say there's a bond, a debenture, which you are holding for, let's say 36 months, then it will be treated as short-term asset. If you are holding it for a period exceeding 36 months, then it will be treated as long-term capital asset. Now, for the holding period discussion, we will include the date you have purchased till the date you have disposed of. So adding those two dates, we need to see whether you are holding it for a period more than 36 months or 24 months or 12 months, whatever the case, whatever the class of asset is applicable. Now, we have understood the holding period of assets. Now let's try to understand what constitutes as a disposal of asset. Now, disposal of asset, it actually means that you no longer have rights on that asset. It does. So it can be with or without consideration as well. So if you are of under the impression that I have an asset and I am selling it off or I am just giving it away at a throwaway price, that will also be considered that you have disposed of that asset and capital gains may be applicable on it. Together. Now, there is an interesting, very, very interesting proposition while considering the selling price. Now, what we understand, whatever amount that I am getting when I'm selling off one particular asset, that actually becomes my selling price of that asset. Now, this holds true for most of the asset, but there is one particular class of asset where it it is partially true. And that class of asset is your immovable property. While considering the sale consideration, while picking out the sale consideration of a immovable property, we not only have to see the actual amount that we are getting, but we also have to see the stamp duty value of that asset. Why is that? Because there is a specific section under the Income Tax Act wherein it says that if the stamp duty value and the actual amount that you are receiving, those two values are in variation of 10%, then the stamp duty value would be considered to be the deemed selling price of that asset. So let's say I have an asset, I have a flat, and I am getting a consideration of 50 lakh rupees for that flat. Now, as per the stamp duty value, the value of that property is as per the stamp duty value, the value of the property is, let's say, 60 lakh rupees, right? So, in that case, the deemed cost of acquisition, deemed selling price for that asset will be 60 lakhs. Why? Because the stamp duty value is more than 10% of the actual cost of selling, actual price of selling. So in that case, you have to be very sure about what registered value is there for that asset, because it may land you into a troublesome situation even though you are receiving a lesser amount just because the stamp duty value is more, right? Going on, let's try to understand if, in your opinion, the stamp duty value is not reflecting correctly. So, what will be the remedy for it? If you are of opinion that stamp duty value is not reflecting correctly, then you need to approach the assessing officer in your case, and assessing officer will refer this matter to valuation officer, who will consider this fact, who will try to establish what would be the correct. Now, as I was saying that in case there is a doubt regarding the stamp duty value, the proper value can always be referred to the valuation officer through the assessing officer. However, it needs to be remembered that value should not be challenged in any of the courts or any of the appellate authority, right? If the value is not challenged, then straight away you can make an application to the assessing officer and the matter will be referred to the valuation officer. Now, there might be a situation in respect of taxes that you are coming to a sale agreement of your asset. Say this is a flat, but you are selling it off. You are selling the flat off, and you have zeroed down on a buyer, and that buyer has given you some amount of advance. Say 1 lakh rupees. The buyer has given you an advance. Now, after some time, the buyer says that I will not be able to purchase this property, and whatever amount I have already given you, you keep that. That is my penalty. Or you say that I will not be refunding this money to you. In that case, what happens? Now, if this is the situation, then the amount that you have received, the amount that you have already forfeited, that needs to be offered as income from other sources in the year in which you are actually selling it off. Let's try to understand this scenario with an example. Say, for example, in 2020, right? Let's say in 2020, in the year 2020, right? And sorry for the inconvenience. Now, as I was saying, that let's say in the year 2020 you decide to sell off your residential flat, and you already lined up a buyer who is ready to pay you 1 lakh rupees, right? The price you have determined is around 50 lakh rupees, and after paying 1 lakh rupees, the token amount, the buyer says that I will not be able to purchase this flat, and he backed out. And as a penalty, you withhold that 1 lakh rupees. In the year 2022, you finally decide to sell that property again, and you got another buyer. Now that buyer is willing to pay you 55 lakh rupees. Now in the year 2022, in the year you are actually making that sale, obviously you will be offering the capital gains that you have incurred on sale of that property. However, the 1 lakh rupees that you have already forfeited, that needs to be shown as income from other sources as well. Previously there was this clause wherein you have received the money. When you have received the money, that used to be reduced from the actual selling price. Now the income tax as has been amended. Now you have to show that 1 lakh rupees of forfeiture, right? Moving ahead, sticking to the long term capital gains. Now long term capital gains has a very interesting proposition as well. Now long term capital gains, if we are talking about the land and building, there is again a possibility you have purchased that property, let's say 10 years or 15 years or 20 years back, and for that flat you have paid, let's say, 10 lakh rupees. After 20 years you are selling that flat off, and in exchange you are getting 50 lakh rupees. Now if we go with the simple mathematical calculation, then the gain is around 40 lakhs, which is a tremendous amount. If we look to the picture, the gain is tremendously big amount. Also, during the year, there is a possibility you will be renovating that flat. You will be spending some amount in the nature of capital expenditure. Say, for example, you are rewiring the flat. The old wiring was bad, so you rewired the flat. Also, maybe the ground, the floor was completely ruined. Therefore, you needed to retile it. So these are the capital expenditure you have made. Now, try to understand capital expenditure means such expenditure which actually maintains the value of that property or increases the value of the property, and which are fixed in nature. That means once they are installed, they cannot be taken back, right? Now, in these years of 10 years back or 20 years back, you have paid 10 lakh rupees. Now you are selling it off at 50 lakh rupees and you are getting a gain of 40 lakh rupees. Does it sound really justifiable? So, to the answer, the income tax agrees that as well. So, what they did is they introduced a concept called cost inflation index. That means, if I put it very simply, the department allows you to uplift the cost of the original property to today's standard. And for that, the income tax department issues indexation point which is assigned to each year. For the current period, the indexation is starting from 1st of April 2001, right? So if you have purchased any asset uh, on or before 1st of April 2001, the assigned value is 100. So let's say in 2001, financial year 2001, you have purchased a flat, right? And you have purchased it for, let's say, 10 lakh rupees, right? Now, the indexation point assigned for that year is 100. Now, you are selling it off in the financial year 21-22. For that, for that financial year 21-22, the indexation point has been assigned as 370, right? So, if we go by the logic, you will be arriving at the value of 31 lakh 70,000 rupees. How? 10 lakh rupees divided by 100 multiplied by 370, and that will give you 31 lakh 70,000 rupees. Now, using these indexation points, you are able to uplift the cost of the original property. Now, if you are selling it off at this point of time, you are getting 50 lakh rupees, right? And if we subtract 31 lakh 70,000 rupees, you will be getting around 18 lakh rupees of capital gains. Now, previously, if there was no indexation point, your capital gains was coming to 40 lakh rupees. Now, after applying the indexation point, your capital gains is coming to 18 lakh rupees. So there is a huge tax benefit. There is a huge tax relief for you. Not only that, the department acknowledges that over the year you will be spending some money to improve that flat, right? Again, it should be capital in nature and it should be fixed in nature as well. So if you are retailing or if you are spending money on rewiring, all those things, so those can be taken as cost of improvement, right? And you can take benefit of that expenditure as well, provided you are making this payment in a proper banking channel and you are getting a invoice, a bill for that. Because without any bill, and if you are making any payment in cash, it will be very difficult to substantiate your claim in the eyes of income tax act, right? So let's say in the year 2010, I have spent 5 lakh rupees on retiling, right? The floor was ruined, therefore I went ahead and re-floored my apartment. And for that, I have spent 5 lakh rupees. Now, these 5 lakh rupees can also be taken as cost of improvement. And not only that, since I have done this more than 24 months ago, indexation benefit will also be given to cost of improvement. These will be called as cost of improvement. Therefore, I will be able to reduce further my capital gains amount, right? So let's say that after applying the indexation points, the cost of improvement is coming to 7 lakh rupees. Now, these 7 lakh rupees will also be reduced from the 18 lakh rupees of capital gains that I had calculated earlier on. So, in total, I will be having a capital gains of 11 lakhs as compared to 14 lakhs had I not applied indexation benefit and cost of improvement for the matter. Further, if I am selling off a flat, if I am selling off a property, there is a possibility I have engaged a broker. and I have paid some brokerage amount to that because, frankly speaking, selling of a flat, going through the buyers, it's a very difficult job. So maybe there's a possibility I have employed a broker, and after the sale was done, I have paid some amount of commission to that broker. That commission amount can also be claimed as deduction from the ultimate capital gains. Ideally, the way to do so would be from the selling considerations, from the sale price, you will be required to reduce the brokerage amount or the commission amount, whatever it may be, right? So after that reduction, you need to reduce your cost of acquisition and cost of improvement, which will be indexed, and from there you will be arriving at your ultimate capital gains on which you need to pay the taxes. Now these are all about long term capital gains on property. Now let's try to understand the long term capital gains on other class of asset, that is shares and securities. Now during this COVID time, many people got into the investing activity into the share market. Many people saw their opportunity when the market was going down, and they bought some shares. Now the market has corrected and people are tempted to sell off their holdings because it will garner them a good amount of return. Now, in if someone has purchased a share in the year, say April 2020, and now they are selling it off in July 2022, obviously they are holding it for a period more than 12 months. Therefore, it will be considered to be a long-term capital asset and long-term capital gains when they sell it off. Now, the key thing that we must remember over here is when you are selling off shares, no indexation benefit is allowed. Indexation benefit specifically is not allowed on sale of shares or securities. So, all you have to do is selling price minus purchase price, and that will actually give you the actual amount of long-term capital gains. However, if you are selling the shares off, that too of a listed entity, Indian listed entity, that will give a tax rate of 10% as compared to a higher tax rate, that is 20% in other class of asset. Furthermore, if you are selling the shares of up to 1 lakh rupees, there is no tax that is levied on the gain amount, obviously. So let's try to understand this scenario with an example. Say in 1st of April 2020, you have purchased X company shares and you have paid 1 lakh rupees to acquire those shares. Now, today, you are selling off those shares for a price of 2 lakh or rather 3 lakh rupees, right? So, you will be having a long term capital gains of 2 lakh rupees. Out of this 2 lakh rupees, 1 lakh rupees will be straight away deducted. On that amount, there will be no taxes. There will be remaining 1 lakh rupees. On this 1 lakh rupees, the tax will be at the rate of 10%. Therefore, if you have made a capital gains, taxable capital gains of 1 lakh rupees, you will end up paying 10,000 rupees of tax. And the education says they will be applicable, obviously, but the tax rate will be 10%. Effective tax rate can go to around 12% or something like that if we consider all the surcharge and education cess as well. Now, there is an interesting case when the shares are acquired before 31st of January 2018. Now, as we know, or rather, if you are not in the know, then please be informed that before 1st of April 2018, there was no tax on long-term capital gains if the shares was sold before that, right? It was exempted. Any amount of capital gains you are having on selling of listed shares, right? There was no taxes. However, In that budget, it was mentioned that if any shares were sold after 31st of January 2018, then on that amount, the capital gains taxes will be made applicable, however, at a lower rate of taxes and giving the benefit of 1 lakh rupees. Now, there were a lot of people who actually held many shares up till that point of time, that is 31st of January 2018. To alleviate them, and they have acquired those shares, and since we all know that for shares there is no indexation benefit, right? So there are scenarios wherein people purchased very good shares at a very nominal price, and suddenly because the company did so well, later point of time the prices shot up massively in the value, and if they are selling off those shares, they would end up paying lakhs and lakhs rupees of taxes, even though at some so we are talking about the capital gains on shares which were acquired before 31st of January 2018. Now, if those shares were acquired before 31st of January 2018, while computing the capital gains taxes, while computing the capital gains for the matter, we need to determine what will be the cost of acquisition for those shares, because selling price we will already be getting, right? Cost of acquisition, we need to compare three values. Firstly, the actual selling price. Secondly, the fair market value that was there on 31st of January 2018. And thirdly, the actual price that you have paid to acquire those shares. Firstly, on the first stage, we will compare the actual cost of acquisition and value prevailing on 31st of January 2018. Whichever value is higher, we will be picking that, and upon picking that value, we will be comparing it with the selling price. Now we will compare these two and pick the value which is lesser. Now, if the 31st January's value is lesser, we will pick that. If selling price is lesser, we will pick that. And we will compute the capital gains accordingly. And after doing this exercise, again, 1 lakh rupees of benefit will be applied, and the lesser tax rate of 10% will also be applied. Now, this special tax rate is applicable. The 10% special tax rate is only applicable for the Indian listed shares. And when I say Indian listed shares, I mean any share that are listed in any recognized stock exchange in India. Excuse me. Now, here might be a question: what will be the period of holding for foreign shares? Right. Many of us, uh, since many of us actually hold some shares that are issued by a foreign entity. Right. This may be due to their employment or something, and they are given a park. Right. And this may be called as RSUs or ESPPs, whatever it may be. Now, to understand the benefit of 1 lakh rupees given to listed shares, it must be understood the government and the act is strictly talking about shares which are listed in Indian recognized stock exchanges. Most of the foreign shares, they are listed in foreign countries, and India does not recognize them to be a eligible stock exchanges in India. Therefore, any foreign shares, they even though they are listed in those foreign countries, they will not be treated as listed shares in India, as India does not recognize those stock exchanges. Therefore, the holding period for those shares will be as par with unlisted shares, that will be more than a period of 24 months. Moving on, now, we have talked at length regarding the long term capital asset and long term capital gains. Now, let's try to understand the short term capital gains. Any asset in respect of, when we are talking about India listed shares, any asset which are held for a period not exceeding 12 months will be treated as short-term capital gains. Now, for that Indian listed shares, the tax rate is set to 15%, and there is no benefit of 1 lakh rupees given to it. So, let's say you have purchased a share on 1st of April 2021 and sold it off on 28th of February 2022. You are holding it for a period less than 12 months. Therefore, it will be treated as short-term capital gains. Now, let's assume you have purchased those shares for paying a price of 1 lakh rupees and you are selling it off at a price of 2 lakh rupees. So, there is a short-term capital gains of 1 lakh rupees, right? So on that 1 lakh rupees, you need to pay a tax of 15%, that is 15,000 rupees. Now this will be added to your total income, and any surcharge or education cess that is applied on the normal income will be applicable on this capital gains taxes as well, right? Any other class of asset which does not fall in the category of Indian listed shares, that will be taxed at the rate of your slabs. If you are following the marginal slab rate of 30%, then definitely it will be taxed at the rate of 30%. Now, we have talked about the taxability portion of it. Now let's try to understand if there are any ways in which you can save the taxes. First of all, if we are talking about short-term capital gains, there is no way you can save the taxes. All the tax saving opportunity is allocated for long-term capital gains, right? Now, when we are talking about long-term capital gains, what are the tax saving opportunities available for you? Now, for long-term capital asset, there is a series of Section 54s which actually talks about tax saving opportunities on long-term capital asset. Let's try to understand Section 54. Now, under Section 54, if you are selling off one house property and you are purchasing another house property, you must invest the entire gain amount in the new house property. Then only the entire amount of gain will be tax exempt in your hand, or rather, it will be deducted from your taxable capital gains. However, it must be noted the amount needs to be invested within a certain period of time. Now, if you are going ahead and outright purchasing a new flat, you must be purchasing the new flat within a period of 2 years. However, if you are constructing a house property, you need to start constructing the house property within a period of 3 years. Now, when I say start constructing, it means that you need to have foundation, walls. The house should look almost ready. It need not be fully complete, but it should be at least very much ready, right? So if you are just putting up some boundary walls and claiming that house is going to be completed, then it will not do. It should have a defined structure of a house property. It should be recognized as a house property under construction. Then only you will be able to claim Section 54 benefit. Now, we have understood that the capital gains need to be invested within a period of 2 years. However, there is this catch. If you are not utilizing the money fully within the due date of filing the income tax return, that is 31st of July 2000 something, in the year of assessment, then the amount should be deposited into capital gain savings scheme account, and from that capital gain savings scheme account you can withdraw the money and start completing the house property, right? That should be the way to approach this. Furthermore, what other tax saving avenues are available for you? Now again, if you are selling off a house property and if you are not in a mood to construct or purchase a house property, what area you can explore is Section 54 EC bonds. Now under Section 54 EC, there are few specific bonds which are available. For example, NHAI bonds are there, RECL bonds are there. Now, if you are investing in this bond, then the capital gains up to 50 lakh rupees can be exempted. However, please note these bonds have a certain lock-in period. That means you have to invest in this bond, stay invested in this bond for a certain amount of time. Right? Now, this Section 54 EC bonds deduction is only available if you are selling off a house property, immovable property for that matter. Moving on, what other tax saving benefit options are available for you? There is again a section 54F. Now, we have discussed at length when we are having the capital gains on account of selling of a house property. What if I sell off any other asset that is not a house property? What will be my tax saving avenue? To that, section 54F is made available for you, under which if you have any long-term asset which is not a house property for that matter, you can invest in a house property or construct a house property, and you can claim exemption on that capital gains. However, unlike section 54, you need to invest the entire amount of sale proceeds. Right. Sorry again. So we are talking about section 54F exemption or deduction. So under section 54F, unlike section 54, you need to invest the entire sale proceeds to get a benefit of not paying income taxes on the entire amount of capital gains. If you invest proportionately, your capital gains will be exempted in that proportion as well. Again, let's try to understand this scenario. Let's say you have some foreign shares, right? You have got some RSUs and you held them for, let's say, 5 years, right? And upon selling them, you have received, let's say, 70 lakh rupees. And after putting the indexation and everything, your capital gains is coming to 30 lakh rupees, right? Now, if you are investing the entire 70 lakh rupees, if you are investing entire 70 lakh rupees in a new house property, the entire capital gains of 30 lakhs will not be taxable in your hand. However, if you are investing only 50% of it, that is 35 lakhs, only 15 lakh rupees of capital gains will be exempted in your hand, and remaining 15 lakh, on that amount you need to pay the taxes. Again, the tax rate would be 20%, and on top of that we will be adding the surcharges and education cess, right? And finally, there is this very less explored street for tax saving, that is section 54GB. Again, that is targeted towards the home sellers if you are selling of a house property. Now, again, there is possibility you have one house property. However, you also have a brilliant business idea. But to start the business, you need to have some sort of capital in your hand. And you are thinking of selling off that house property, and whatever proceeds you are getting, your plan is to invest that in your startup, in your business. In that case also, the tax saving opportunity is available. If you are investing the amount in purchasing the share of your business, that means if you are investing the amount to take shares of the company that you are establishing, then the capital gains can be exempted under section 54GB. However, the company must utilize the fund that you have invested into purchasing plant and machinery, that too within a period of 1 year from the date you are making this investment. If they are not making this investment, then the capital gains will be taxed in your hand, right? Now, these were the things, or these were the understandings of capital gains taxes for you. Hopefully, you have taken away some key points which can save you some taxes or plan you to file your income tax return on proper time and be tax compliant. Now, here I would like to mention one thing, that filing the income tax return for capital gains actually requires capital ITR Form 2. And if you are inputting certain details regarding the capital gains, ClearTax portal will automatically pick and select ITR 2 form for you. Second thing is, if you are a broker, if you are a investor, and if you are investing in Indian listed entities, there is a possibility you will be having some broker statement with you. ClearTax, we support direct upload of broker statement. Right. We have tied up with multiple brokers and we support the capital gain statement that they are providing. So for that, you can have 100, 200, 500 line items in your capital gain statement. All you have to do is select the appropriate statement and upload it. And all the capital gains data will be picked from the capital gains statement and replicated perfectly. And it will not only that, for some brokers, we also pick the dividend paid details as well. So if you are planning to use ClearTax platform, then know this. If you have the supported broker statement, your income tax return will be ready within a matter of minutes. Now, this was the understanding of the capital gains from our side. Now we will be having some question answers so that your doubts can be cleared further. If you have any questions, please drop those questions in the chat box. Right. So I'm not really seeing any questions over here. So I believe that is our time to call it a day and end our session. Just try to remember the due date of filing the income tax return is almost upon us. It's on 31st of July 2022. So if you have not filed your income tax return, I would suggest don't be late. Try to use the platform that is clear and file your income tax return as early as possible. And as explained, the capital gains is nothing to be feared about because we have made it very clear and very simple to use. So, best of luck and file your income taxes as early as possible. Thanks for your time. Bye bye.